Okay, in this video we're going to be looking at the government's main forms of revenue. So just focusing on revenue. Just be mindful that fines aren't included in government revenue because that's collected by state governments. So there are forms of revenue that are collected by the states, not federal government, so that won't be included. So the main sources of revenue and receipts at this point can just be considered the same thing. So we've got direct taxes, indirect taxes, and non-tax government revenue. Be mindful that direct taxes make up the majority of the tax made collected by the government, around 68%. Indirect taxes and then other forms of government revenues around 6%, making indirect taxes around about just under 30%. So direct taxes, the definition of a direct tax is a tax that is paid directly by economic agents and usually varies with income earned. So it's taxes paid on the incomes of consumers or producers, and it's paid directly by agents depending on their level of income. It's mainly taxed on wages and salaries. Then we've got indirect taxes. Indirect taxes are levied on purchases made by economic agents. So one is on the income by economic agents, consumers and producers. The other is on purchases by economic agents. It's not dependent on income, and we generally refer to most of these indirect taxes as being regressive because they make up a higher proportion of low-income earners' salaries. So things like GST, excise taxes and things like that, they're regressive because the tax makes up a higher proportion of the low-income earner's salary. So a 10% GST on cars, for example, that tax might be $1,000. On a $10,000 car, that $1,000 is a higher proportion of low-income earners' salaries, and therefore it's considered as having regressive effects. And we have other forms of non-tax government revenue, which we'll talk about as well. So direct taxes, as I said, it's a tax on consumers and companies' incomes, and some forms of income tax. The main one is personal income tax, which is about 48% of total revenue. This is tax levied on incomes based on the marginal tax rate. So we have a progressive income tax system in Australia, and you pay that progressive income taxes on any wages, salaries, rent, interest or royalties you earn in a given year. So it's marginal tax rate brackets, meaning you don't pay any tax on the first $18,200, then you start paying 19 cents, 32.5 cents, 37 cents, and the top marginal tax bracket at the moment is 45% or 45 cents per dollar, which is levied on incomes above 180,000. The second one, company tax. Again, it's a form of income tax. It's not personal income tax, but it is income tax. It's proportional tax, which means it's paid as a flat rate. So you're paying 30% of all profits in tax, and that stays at 30% regardless of your profits. So it's proportional and it stays at the same rate regardless of the income you earn. You still end up paying more the more you earn, but it's at a flat rate. It's 30% for big companies earning more than 10 million at the moment, and 27.5% for companies earning revenue of less than 10 million as of the 2016-2017 budget. Other forms of direct taxes, capital gains tax. Capital gains tax is important because it's important when you're talking about why higher property prices leads to revenue and budget surpluses. So capital gains tax you pay when your investments make money, so whether that be shares or property are the two main ones. So when if you're asked why do higher property prices or higher share prices benefit the budget, you can talk about the fact that it leads to more capital gains tax. You pay capital gains tax at 50% of your normal tax rate. So if your house appreciates in value by 100,000, you don't pay your normal tax bracket, you pay basically half your normal tax bracket. So if you're in the 45-cent tax bracket, you'll pay around 22.5 cents tax per dollar. Capital gains tax, really important when you're linking to revenues related to property prices increasing or share prices increasing. Medicare levy, at the moment the Medicare levy is 2.5%, you pay it on every dollar you earn. So it's basically the way the government gets money to subsidise healthcare, and everyone pays 2.5% of their incomes in the Medicare levy. Fringe benefits tax, taxes on non-cash payments, again a form of income tax. So it may be that you get, like for example, a company car or free holiday or something like that. You get taxed on that as an employer, and they generally pass that on to the employee who gets the fringe benefits. Superannuation tax, any money you put into super, you get taxed at 15%, and that can be on dividends, capital gains, salaries, etc. And petroleum resource rent tax, it's a 40% tax to companies on their profits that try and shift their petroleum operations offshore. Not very important. Indirect taxes are around 25% of total revenue. Again, they're levied on purchases. So excess duties and tariffs are one example. Excise duties is one example, not tariffs. Excise duties are things like excise taxes, so placed on petrol, LPG, alcohol, cigarettes. Again, they're regressive, so they affect low-income earners more. Petrol, for example, is at 30 cents per litre, is an example of a regressive tax, regressive excise tax. They are often indexed to inflation, meaning the tax goes up as inflation increases. Tariffs, so tariffs on textiles, clothing, footwear, generally around 5 to 10%. And they're also called customs duties. Goods and services tax is around 15% of total revenue. Goods and services tax is generally, at the moment, levied at 10%. And that can be on things like basic food items, gifts to charities. Sorry, it's not on things like basic food items, gift to charities, healthcare, medical products, things that are deemed as necessities don't get the GST, but everything else that's deemed as a non-necessity has GST associated with it. Non-tax revenue is the last type. Non-tax revenue includes revenue from government businesses. So government businesses that are making a profit, like Australia Post, that will be a form of revenue for the government because it's run by the government. Any profits that they make will lead to higher increased revenue for the government. Asset sales of government business enterprises. So if the government wants to privatise something like Medibank, when they sell Medibank, that they get money, and therefore that will lead to profits as well. And also, they also earn interest on their future fund, so they've got money saved up in a future fund. The government earns revenues from petroleum royalties, repayments of loans by the state government, so they'll collect money from the states giving them money based on their loans that they had. HEX repayments, so people pay their HEX back every year, they get money for that, as well as student and property rentals as well. So there's some examples of government revenue that aren't forms of tax. So sources of government revenue, as you can see, income tax is the main one, then company taxes, sales taxes, etc., etc. Won't talk about this too much later, but some of the impacts on the revenue mix. Revenue is expected to increase in the next year by around 6%. There's been about a 4.5% increase in income tax due to bracket creep, so people are pushing into higher tax brackets. Company tax has been falling recently because of the weaker mining sector. Having said that, it has boosted a little bit this year with the mining sector picking up again. The terms of trade is expected to stabilise and has improved this year, which has helped to boost profits in the mining sector and increase company tax. I'll talk about this in class. Thank you.